Hello friends, I am Professor Vinayak Pagedar from Ideal Classes. First and foremost, let me wish you all the best for your Ipcc November 2014 exams. May you clear it with flying colors. I am here to discuss a few amendments and important provisions of income tax which are related to your November 2014 exams. Remember, it's governed by the Finance Act 2013. The assessment year is 2014-15. Now, let me first start with section 32AC, which was a new section which was introduced. And the logic behind it is to give an additional tax incentives to companies who are capital intensive into plant and machinery. Now, we've got section 32, which gives us the benefit of depreciation. Obviously, depreciation is nothing but a recovery of cost. We have already incurred the cost on the asset and now it is to be recovered by giving us an internal reserve through the depreciation route. Depreciation is less of an expense, more of an allowance, a type of an internal reserve which gives you a tax incentive to recover the cost of your asset. Furthermore, those who are engaged in manufacturing, that is your industrial undertakings, even power units, are given the benefit of additional depreciation. Now, the word additional depreciation is technically a misnomer. I would look more at it like accelerated depreciation, because it helps a manufacturer to recover the cost of the asset faster. But if you look at companies, and those companies who are investing huge amounts in plant and machinery, they will be definitely pressured to recover their investment. And to encourage them to do so, we give them a tax incentive under section 32AC by allowing an investment reserve, or sometimes we call it an investment allowance reserve. The logic is, by giving a tax benefit, the cost will be recovered a bit faster. Now, this benefit is only to a company. You see the slide on your screens. The benefit is only to a company assessee. It should be engaged in the manufacture or production of an article or thing, any article or thing. What we mean is an industrial undertaking, a manufacturer. And remember, the deduction which is allowed is 15% of the actual cost or the installation cost or the total cost of the plant and machinery. This is over and above the depreciation and the additional depreciation which you get under section 32(1)(2) and 32(1)(2)A respectively. So, 32AC is nothing but an additional tax incentive given to the manufacturers. Now, here the deduction in the financial year 13-14 is nothing but 15% of the actual cost. You get this deduction for 2 years. So, if you again invest in some plant and machinery in the next year, you get another 15% of the actual cost minus the total actual cost up to 31st March 2015 minus the deduction which you have claimed in financial year 13-14. So, this deduction is allowed in 2 consecutive years subject to certain conditions. You see on your screen, the eligible asset is plant and machinery. So, building, your furniture and your intangible assets will not be eligible for the investment reserve. The plant and machinery is segregated into 2 parts. If you look at UVR dog, any plant machinery which is used earlier, a simple acronym, a plant and machinery which is used earlier, that is second hand. Vehicles, ships, aircrafts, any plant and machinery installed in a residential accommodation, like for example, AC is installed in staff quarters, office appliances, guest house, and the D stands for any plant and machinery on which you have claimed 100% deduction, whether by way of depreciation or otherwise. Now, on these particular plants and machinery, you won't get the investment reserve allowance, and on other plant and machinery, you get the investment reserve to the extent of 15% of the actual cost, provided you have made the investment of more than 100 crores. This means that only when you go capital intensive into plant and machinery, you are a company, will you get the investment allowance reserve benefit. So you need to have a minimum investment of more than 100 crores to get the investment allowance reserve benefit. So plant and machinery investment up to 100 crores, no investment allowance. More than 100 crores, you get your investment allowance reserve. Remember, even if you are investing below 100 crores, you still get the benefit of depreciation, the normal depreciation, and also the additional depreciation because you are a manufacturer. But then to get 32AC benefit, you need to go more than 100 crores. Correct? So on the screen you see what is UVR dog, whatever is used earlier, vessel, ships, aircrafts, any plant and machinery installed in a residential accommodation, then any plant and machinery on which you can claim 100% deduction, office appliances, any computers etc. which are installed in the office, and any plant and machinery which is installed in a guest house. So that does it with your section 32AC. Now here there is a stipulation attached to section 32AC, is that the new plant and machinery for which you have taken the investment allowance reserve, it should not be transferred or sold for a period of 5 years. You have to remain locked in the asset for a period of 5 years. Remember that if you transfer it under the process of an amalgamation or a demerger, then the successor, that is the resulting company or the amalgamated company, they can still take the benefit in the next year. However, if this asset is sold otherwise than by way of amalgamation or demerger, whatever tax benefit has been claimed earlier, that will be reversed. The deduction claimed earlier under section 32AC will be taxed as income from business and profession. And remember, since the machinery is also a capital asset, there will also be some capital gains implication. Okay. Now, we all know that securities transaction tax is a tax which we pay at the time of incurring a taxable securities transaction, mainly when securities are sold on a recognized stock exchange in India. Now, similarly, people who are trading in commodity derivatives, they do incur commodities transaction tax. And for traders who are trading in commodities derivatives, on the sale, they are liable to 0.01% commodities transaction tax. Now today there is a specific section, that is 36(1)(16), which has been introduced to give them the deduction of commodities transaction tax. Okay. Now we all heard about section 50C, and 50C obviously is a provision related to capital gains. It's a provision related to capital gains. You definitely know that today land and building, that is real estate, is the biggest source of black money or creation of black money. Black money further creates a lot of inflation because that money which is not recorded for tax purpose gets sucked out of the economy. Now to prevent this, a minimum amount is brought into taxation. Remember, despite the inflation aspect, in spite of the inflation aspect, one more aspect is that the exchequer loses a very large amount of tax. If I sell my flat for 1 crore, then only I may record 60 lakhs in books, pay stamp duty on 60 lakhs, and the 40 lakhs goes escaping out of the tax ambit. The main aim is to tax a minimum amount. We cannot bring each and every tax evader to book. So we do this by introducing a provision wherein a minimum amount is definitely going to be taxed. And therefore 50C briefly says that in case of a real estate transaction, being land or building or both, where the assessee declares a consideration which is less than the stamp duty value, then the stamp duty value is to be taken as the full value of consideration. I look at it in a different manner. I'll say the amount which is brought into the tax bracket as full value of consideration in case of capital gains is either the declared consideration by the assessee or the stamp duty valuation, whichever is higher. So at least the stamp duty valuation, if you declare lower, the stamp duty valuation is brought into tax. It is treated as the full value of consideration for capital gains. But what about builders? When a builder sells a flat or a farmhouse or a bungalow, or a property dealer sells some real estate, land, maybe so on and so forth, you call it a land, a plot. In that case, the provisions of stamp duty value were not applicable. Now, this created a distinction or a disparity between real estate being stock in trade and real estate being a capital asset. Where it was a capital asset, it is brought into minimum taxation. So, why not when it is stock in trade? And today, if anybody sells real estate being land and building or both, then for the purpose of computing the income from business and profession, if you declare less than the stamp duty valuation, the stamp duty valuation is treated as the deemed sale consideration. So this way, today 43CA and section 50C are two parallel provisions. 43CA takes care of the sale consideration in income from business and profession, or you call it profits and gains, and 50C takes care when a capital asset is transferred to bring into minimum taxation at least the stamp duty value. So you see your slide, this provision is applicable to sale of land and building which is not a capital asset. When I say not a capital asset, we mean it is stock in trade. And the full value of consideration for the purpose of business and profession is the declared sale consideration or the stamp duty valuation, whichever is higher. The upper arrow, the upward arrow which I have indicates whichever is higher. A very important part is that remember, the stamp duty valuation should be considered on the date of making the agreement and not on the date of registration. The important date when you get into the transaction is the date where the circle rate or the stamp duty value is to be picked. Correct? It is not the date of registration which is important. The stamp duty valuation should be taken on the date of making the agreement. Now, there could be a case when you enter into an agreement today and register it maybe a couple of months down the line. In this case, the priority is given to the agreement date and not to the registration date. Okay. Then we have said that a parallel section to section 50C, the X section aims at basically getting a parity between the taxation of consideration and capital gains and income from business and profession, as I have already discussed. Okay. Let's move on to another provision which is 48(2)(b). Now, as you know, section 40 mainly deals with disallowances. So, after clause 2A, a clause 2B has been introduced, wherein a state government undertaking, when it makes a payment of any royalty, any license fee, etc., service fees, by whatever name you call it, to the state government, then such amount is to be disallowed. Such amount is to be totally disallowed in computing the income from business and profession. Now, what do we mean by a state government undertaking? It means any undertaking which is established under a state act, any undertaking in which at least 50% of the equity share capital, not the preference share, the equity share capital is held by the state government, an undertaking in which 50% is held by A and B, that is a corporation established under a state act and the state government together, they hold 50%, greater than 50% equity shares. An undertaking or a company in which at least 50% of the directors, the majority of directors can be removed or appointed by the state government, or the management can be controlled by the government, and an authority or board established under a state act or controlled by the state government. These are what are called as state government undertakings. So today, when these institutions make a payment of any royalty or a license fee or a service fee or a privilege fee, etc., to the state government, then such amount is totally to be disallowed in computing the income from business and profession. Okay. Moving on to income from other sources, we look at the taxation of gifts. Earlier 56(2)(7) contained gifts up to the immovable property stage, that is gifts of money, gifts of movable property, also gifts of concessional purchase of immovable property. It also dealt with gifts of immovable property, but there was no provision, or rather the provision was introduced and withdrawn in relation to concessional purchase of immovable property. Now this created a problem, that is, today if I sell my real estate, land and building to you, you are not my relative, etc. If I sell it to you at a lower price, let's say the price is 1 crore, I sell it to you for 10 lakhs, then the differential 90 lakhs used to escape taxation. Clearly this is a tax evasion tool. If I use the word gift, that means it is without consideration. The act does not spell the word gift. It talks of a sum of money or property, etc. received without consideration. So the moment I pay some consideration, no matter how small it is, the computational provision fails. Correct? There is a breakdown of the provision. Now to cap it, the concessional purchase of immovable property is brought to be taxed under section 56(2)(7). Remember, definitely when you are exempting the gift in certain cases, that is inheritance or will at the time of marriage, in case of contemplation of death, in case of a relative, when you look at something without consideration from a hospital, a university, a trust, charitable institution, local authority, scientific research association, so on and so forth. These as such are kept out of the tax ambit. So there should be no reason why, when a gift is exempt in these cases, should a concessional purchase be taxed. I don't see any reason, and that is why if there is a concessional purchase from I am Dr. Hatlo in these situations, we give an acronym I am Dr. Hatlo, still it is not taxable. In other cases, when you don't receive from a relative, when you receive it from a non-relative, it's not in the excluded cases. In that case, you have to look at the benefit derived. If the excess, that is the stamp duty value minus the consideration which you have paid for it, is within the prescribed limit of 50,000, then still it's considered as a petty amount and not taxed. But where it exceeds 50,000, then the whole of such amount is taxed. Let me make it very clear. Suppose in this case the stamp duty value is, let's say, 5 lakhs, and the consideration which you have paid, let's say is 50,000. If you look at this 4,50,000 difference, I would call it a profit on purchase. This is your benefit. For a valuation of 5 lakhs, you are paying only rupees 50,000. So indeed you made a benefit of 4,50,000. And this 4,50,000 is above the threshold limit of 50,000. It does not fall in the exclusion cases. It's above the threshold limit, and therefore this 4,50,000 entirely is to be brought into the tax ambit. I am not saying that exclude 50,000 and then tax the difference. If you look at it, this 50,000 is what I have paid for it. So this is not my profit, this is not my benefit, this is not my faida, it's an expense. So the benefit which I have derived is 4,50,000, and so this 4,50,000 is to be taxed as a benefit. This is to be fully taxed. The 4,50,000 will now be brought into the tax ambit. Yes, if this was 4,50,000 and the profit derived is 50, then it is within the threshold limit of 50,000, and therefore nothing will be taxed. But suppose this was 3,50,000, then this profit becomes 1,50,000. The profit on purchase, as I loosely call it, the benefit derived is 1,50,000, then this 1,50,000 is to be taxed in its entirety as a profit. Correct? You see the chart? I am Dr. Hatlo. It's not taxable. In other cases, you look at the stamp duty value minus the consideration, the benefit as I call it. If it's within the threshold, not taxable. If it goes beyond the threshold of 50,000, then the full amount, that is the entire profit, as we have discussed, is to be taxed. So there's your acronym for you: inheritance, marriage, death, contemplation, relative, hospitals, medical institutions, universities, trusts and research institutions, and then finally the local authority. Remember, the Act does not define the term gift, etc. It uses the term without consideration, and to break the provision we may have paid some nominal consideration to create a loophole. Today this loophole is fixed. An important point which you should remember is again the stamp duty value which we talk about here is to be picked up on the date of agreement and not on the date of registration. So here the stamp duty valuation should be considered on the date of agreement and not on the registration date in case both conflict. Correct? Now the most important part is this provision will apply only if at least part of the consideration or the entire consideration is received in a non-cash mode prior to the agreement date. That means when the provision takes place entirely, when the transaction is entirely in a cash mode, then again this provision would fail. Correct? Okay. Now we are through your income from other sources, through the major provisions of income from business and profession. Let us move on to our chapter 6A. Again some important provisions. Section 80C gives you a benefit of specified investments. Remember a brief structure, I'll give you a brief guideline. If you look at your entire 80C series, when I say 80C, I also mean CCC, CCD, CCG, all this series, they talk about investments. Chapter 6A has a very definite structure. These are all sections which are linked to investments. Then when you talk of D, your DD, your DDB, all these sections talk about health. So your health insurance premium, your preventive health checkup, your ATDD, your disabled dependent, the specified diseases, Darauni Bimaria, your Rule 11DD, and this entire series talks about health. Then you go to 80E and your 80EE, you will observe that this is an interest payment. Your interest for higher education, your interest on your housing loan, the new provision again which we have to discuss. And then your G talks about all your payments, your donations, your rent payments, so on and so forth. If you again look at your 80I series, it's talking of tax holidays. And 80, you don't forget, it's nothing but the benefit given to a handicapped assessee. So this is a brief structure which you can keep in your mind to remember these sections. The C series is all about investments. The D series is all about health. The E series is about interest. If you look at the G series, it is all about payments. If you look at the I series, it is all about your tax holidays. Your 80IA, IB, IC, ID, IE, IAB, all are talking about some sort of tax incentive via tax holidays. Now coming back to the provision of section 80C. If you look at the provision of life insurance premium, then if any premium is paid on a policy which is purchased prior to 1/4/2012, prior to 1/4/2012, here I refer to it as the older policies, then the premium paid was eligible for a deduction to the extent of maximum 20% of the capital sum assured. 20% of the capital sum assured. This is looking at an endowment policy having a period of 5 years. But then later, from 1/4/2012 onwards, the section was amended and the maximum limit was extended or rather lowered to 10% of the capital sum assured. Now, from 1/4/2013 onwards, a provision has been introduced, and this provision says that when you make the premium or you pay the premium for a person who suffers from a disability under section 80U, or suffers from a specified disease mentioned in section 80DDB, then the threshold limit in this case is 15% of capital sum assured. So you have to stay within that 15%, and if you pay a premium in excess, you top up the premium beyond 15% of the capital sum assured, then in that case the excess will not be allowed as a deduction. For example, if the capital sum assured is 1 lakh, then 15% is 15,000. If you paid 20,000 in any year, then in that case only 15,000 will be allowed as deduction. This also has an implication as far as section 1010D is concerned, and today where the premium paid exceeds the threshold, then you don't get an exemption of the maturity amount at the time of maturity. So in any year, if I pay a premium which is more than the threshold limit, be it 10%, be it 15%, be it 20% of the capital sum assured, then the maturity amount will not be exempt under 1010D. For your knowledge, the death benefit still continues to be exempt, but the maturity amount will be taxed. So a similar proviso has been inserted in section 1010D to bring forth this amendment. So 3 things: for policies prior to 1/4/2012, the limit is 20% of the capital sum assured. For policies on or after 1/4/2012, the limit is 10% of the capital sum assured, and for those policies which are taken on the life where the insured person is a handicapped person under section 80U or a person suffering from a specified disease as referred to in 80DDB, then the threshold is 15% of the capital sum assured. You have to be within the threshold. Anything paid in excess is not going to be allowed as deduction, and when you pay in excess, not only does it have an implication now, but the maturity amount is to be taxed. Okay. Now moving ahead, your ATCCG provides a deduction to a new retail investor, a person who has never carried on a taxable securities transaction. Being a resident individual, he should be a resident individual, not a non-resident. He can't be an HUF, only for resident individuals, and a deduction is allowed to the extent of 50% of whatever you invest in a notified equity scheme, or the amendment even says equity shares which are notified. So today it is 50% of the amount invested or a maximum of rupees 25,000. Since I say maximum of 25,000, it means 50% of the amount invested or 25,000, whichever is less. For example, if I have invested 2 lakhs, if I made an investment of 2 lakhs, then 50% of this 2 lakhs will be 1 lakh. But 1 lakh cannot be claimed as deduction because the maximum deduction which can be claimed is only rupees 25,000. So the maximum investment which you should make ideally is 50,000. So if you make 50,000 deduction, you can get 25,000 as deduction. If you make a 50,000 ka investment, you can get 25,000 as deduction. Okay. Now here there are certain conditions attached to it. The first is, I told you he should be a new retail investor. And his GTI should be up to rupees 12 lakhs. GTI, when I say GTI, I mean the gross total income. Earlier the gross total income limit was up to 10 lakhs and now it has been increased to rupees 12 lakhs. You can also make investment in these notified equity saving schemes or equity shares for a period of 3 consecutive years. 3 consecutive years. That means you can make the investment in the year financial year 13-14, followed by 14-15 and 15-16. Obviously, it comes with a lock-in period, but then investment benefit in this section can be taken for 3 consecutive years starting from the initial investment years. Remember, if your gross total income goes more than 12 lakhs, then this section is of no use to you. So, whenever you see investment in a notified equity saving scheme in the question, please look at the gross total income first. If the gross total income is 13 lakhs, 12 lakh 50, 12 lakh 75, 15 lakhs, 20 lakhs, then in that case, you will not get a deduction under this section. If your gross total income is up to rupees 12 lakhs, below rupees 12 lakhs, then you can take the benefit of this section in the year financial year 13-14 and 2 consecutive years. Correct? So, here the slide says he should be a new retail investor. The gross total income is up to rupees 12 lakhs, and finally the investment can be carried out for claiming deduction in another 2 consecutive years. So, 3 consecutive years including the initial investment years, financial year 13-14, 14-15 and 15-16. Okay. Now, the provision of Mediclaim insurance premium. Basically, you all know that Mediclaim premium is nothing but it covers the risk of health. If we are hospitalized, then if we have paid Mediclaim premium in the past, the insurance company will reimburse us our hospital expenses to the extent of cover. Now, in this case, there are some amendments in section 80D, a small amendment. Nevertheless, you can make an investment up to 15,000 for yourself, spouse, children, a separate 15,000 for your parents if you are an individual. And remember, if any of you are a senior citizen, then that category, whether it's self, spouse, children or the parents, the premium can be increased by another 5,000. The overall limit theoretically can go up to 40,000, and it includes a maximum of 5,000 rupees for a preventive health checkup. When you analyze the provision of Mediclaim insurance premium, you should ask yourself who should pay. The assessee is an individual or HUF, so the assessee should pay. If I am an individual or HUF, who do I pay for? For myself? Yes. For my spouse? Yes. For my parents? Yes. And for my children, provided they are dependent. I cannot pay for my independent children. Brother, sister, uncle, aunt, etc. are not covered here. I can pay only for 4 parties: self, spouse, parents and the dependent children. If I am an HUF, the HUF does not have a spouse, the HUF does not have children, it has members, so the HUF can pay for any member. Now remember, the third question which you ask yourself is to whom do you pay? You can pay to the General Insurance Corporation of India, GIC as we call it, an approved insurance company which is approved by the IRDA, to the central government health scheme. But what used to happen is, when you used to pay to other health schemes which is not the central government health scheme, then the deduction was denied in the past. Now, to bring the other health schemes also into the ambit of tax benefit, today if you pay to any other health scheme, even besides the central government health scheme, you get a deduction. So, to whom do you pay? Number 1, to the GIC, to an approved insurance company. Third, to the central government health scheme, and also to any other approved health scheme which is approved by the central government. So, this was the amendment in section 80D. Okay. Now, moving ahead, we look at 80EE. If you remember, I told you your C series is all about investments, your D series is all about health, your E series is all about interest, your I series is all about tax holidays, a broad structure. Again, another analysis. Certain sections are related to payments, certain deductions are related to incomes, and certain sections are related, the only section which remains is related neither to an income nor to an expense. Let me clear it. If you look at your C series, D series, E series, even your G series, when you make a payment, you get the deduction. Then, if you look at your ATI series, your ATP and all these sections, they are giving you a deduction for certain profits. Correct? For example, if you receive some profit from a unit in the northeastern state, you get a tax holiday for such profit for a period of 10 years. Correct? Under ATIE. Under ATP, the income of a cooperative society is eligible for deduction. Under ATU, you satisfy just one condition, and that you should be physically or mentally handicapped as defined. The term handicap has been defined. It includes cerebral palsy, autism, mental retardation, multiple disabilities, so on and so forth. Blindness, low vision, locomotor disease, all these are also covered. Let's not stray. Let's come back to section 80EE, a new section which is introduced to encourage investment in a residential house property. Before I start with 80EE, let us once again remind ourselves that if I have taken a loan to purchase or construct a residential house property for the acquisition on or after 1/4/99, then in case of a self-occupied property for residence, SOPR, I get a deduction of maximum 1,50,000. Correct? This is section 24B. Correct? In case of a let out property or a deemed to be let out property, I get the full deduction for interest. I get the full deduction for interest. Now, if I already get the entire deduction for interest, if I let out my property, when I compute section 22, that is the income from house property under the basis of charge, whatever interest is related to a let out or a deemed to be let out property is fully allowed as deduction. So here in this case, you cannot get 80EE deduction because that would result in double deduction. We don't want to give you an undue benefit. So logically speaking, if LOP, DLOP goes out of the ambit, we are left with the house which is SOPR. And 80EE today will apply only in case of a self-occupied property for residence. Remember here, the assessee should be an individual. Not even an HUF can get the benefit under section 80EE. You have to be an individual. Now here the benefit is up to a maximum interest of rupees 1 lakh over and above what you get here. A maximum interest of another rupees 1 lakh, and this benefit you can take in 2 years. You can't claim 1 lakh each year, but the 1 lakh can be spread out over 2 financial years, 13-14 and 14-15. See how? Suppose the total interest which is related to a self-occupied property for residence is, let's say, 3 lakhs. I am assuming we have purchased or constructed the property on or after 1/4/99. In fact, here if you look at this section, it says that the loan should be sanctioned in the financial year 13-14. So assuming it is sanctioned in the financial year 13-14 and the interest arises 3 lakhs in this year, the first 1,50,000 of interest can be claimed under section 24B in the statement of income from house property. In the statement of income from house property. Another 1 lakh rupees you can get a deduction under section 80EE. So your total interest benefit in respect to interest here is 2,50,000. The sad part is the excess 50,000, you don't get a deduction for it. The example should be very clear. If you've incurred interest of 3 lakhs, then 1,50,000, 24B, the house is SOPR, remember, don't forget that. LOPs are not covered here. Already the full deduction would have been available under 24. And SOPR, the interest arising in financial year 13-14 is 3 lakhs. 1,50,000 under 24B, statement of income from house property. Another 1 lakh under 80EE. And 50,000, the sad part is you don't get a tax benefit for it. Remember here, you say that it's the sad part, but the law gives you a benefit on account of social security to create your own house property. You should be satisfied with that. The interest which you pay for your own house property is a personal expense. So since you are getting a tax benefit, don't be sad, be happy about it. Let me change the example. Let us say the interest is 1,90,000 in case of the SOPR. So again 1,50,000 you claim as deduction under section 24B, interest on loan, house property. Now you are left with only 40,000, and this 40,000 you can get as deduction under 80EE. This is in the financial year 13-14. Again in the next year, you will be incurring some interest. And assuming in the next year also your property is an SOPR, then can you get the deduction again in the next year? And the answer is yes, but you can get a maximum deduction under section 80EE in the financial year 14-15, maximum to the extent of rupees 60,000. So the total deduction which you get in is 1 lakh rupees. If you observe this, 40,000 you could claim in financial year 13-14, and total deduction in 2 years put together is 1 lakh rupees. So you are left with another 60,000 to the extent of 60,000 which you can claim in 14-15. The question in your minds is, what about 15-16? 15-16 mein kuch nahi. Already they have given you a lot of incentives. Correct? So no deduction in 15-16. So if you look at your slide, the assessee should be an individual. The deduction of interest is maximum 1 lakh, and deduction for financial year 14-15 is 1 lakh minus deduction which is claimed in financial year 13-14. Okay. Now some conditions. As we have discussed, the loan should be taken for the purchase or construction, that is the acquisition of a residential house property. It should be makan, not dukan. It should be a residential house property, not a commercial property. Remember, the loan should be taken from a financial institution, something like a housing finance institution or a bank. The third is, importantly, the loan is sanctioned in the financial year 13-14. Very, very important. Not before, not old loans. It's the new loans which will play a part. The maximum amount sanctioned should not exceed rupees 25 lakhs. So we are catering to the middle class who take a loan of 25 lakhs, and the value of the house again should not exceed rupees 40 lakhs. So if you are planning to buy a bungalow of something like 10-15 crores, then you can't take the benefit of this section. Remember, the value of the house should be up to 40 lakhs and the maximum loan which you have taken is 25 lakhs. On the date of loan sanction, you should not own any other residential house property. This is an important criterion. And remember, as I have already discussed, the moment you claim a deduction under this section, you cannot claim a deduction of the same interest under any other provision for the current year or any other year. this will amount to double deduction. And so that is why if we look at our LOPs and our DLOPs, we get a deduction under 24, so we keep them out of the SOPR and ambit. The entire interest is allowed under section 24. Correct? So this says that you can't get a double deduction. Otherwise, if I am an assessee, I'll find this as a loophole. I'll take a benefit under section 24 as well as under 80EE. This should not happen. Okay. Now, one of your favorite sections is the donations. And donations are covered under section 80G. You could be any assessee. There are 4 categories: the unlimited or the unrestricted category. In this, you got a 50% block, a 100% block, and also then you have, subject to a qualifying limit, the limited category, a 50% block and a limited 100% block. For example, when you donate to a family planning association, it comes under the limited 100%. Your charitable trusts and all come under the 50%. If you look at the unlimited 100%, under the unlimited 100%, you have got most of your provisions under section 80G. The unlimited 50% contained Rajiv Gandhi Foundation, Jawaharlal Nehru Memorial Fund, the National Children's Fund, the Indira Gandhi Memorial Trust, and the Prime Minister's Drought Relief Fund. I repeat, the Rajiv Gandhi Foundation, the Jawaharlal Nehru Memorial Fund, the National Children's Fund, the Indira Gandhi Memorial Trust, and the Prime Minister's Drought Relief Fund. I used to remember it this way, without any offense to our great leaders. I used to remember it this way: Gandhi Nehru ke sukhe bacche. Gandhi, Indira Gandhi, Rajiv Gandhi. So Gandhi is covered. Your Nehru, Sukha, that is drought, and Bacche, that is the National Children's Fund. Now today the problem is Bacche bhag gaye. The National Children's Fund is out. Gandhi, Nehru, Sukhe reh gaye. You got the Gandhis, Rajiv Gandhi, Indira Gandhi, Jawaharlal Nehru, and the drought. So what about the National Children's Fund? तो बच्चे कहाँ भाग गए? बच्चे भाग गए into the 100%. And the National Children's Fund, which is a very good institution, you should donate to such an institution, not connected to any caste, any creed, any religion, really working for the benefit of children. You give a donation to this institution, you should be entitled to a tax benefit of 100%. And today when you give a donation to the National Children's Fund, 80G gives you a deduction of 100%. Okay. Remember, 80GGB and GGC, these are also donations. 80GGB is the donation to a political party by an Indian company, also to an electoral trust. And 80GGC is the same donation, but it applies to other assessees. Remember, local authorities etc. are not covered under this section. So you can say other assessees excluding local authorities or institutions funded by the government. Now you get a 100% deduction under section 80GGB or 80GGC. If you are an Indian company or you are another assessee, you make the payment, take the 100% deduction for the donation. But now a restriction has been added that such amount should not be given in cash. So the moment you make a cash donation to a political party or an electoral trust, the deduction will be fully disallowed. Whatever be the amount, the entire amount is to be disallowed. Okay. Moving ahead to your TDS provisions. Now see, basically when we deal in real estate, suppose I sell some real estate, then I receive a payment. I am the transferor, you are the transferee, you are making a payment to me because you are purchasing real estate from me. Today if you purchase any real estate from me, then in this transaction I may not declare my PAN number. There were many assessees who were not declaring PAN numbers in order to prevent from coming on the record. So today a liability is cast on the transferee. The transferee is that the purchaser has to deduct tax at source at the rate of 1% and pay it into the government's coffers on the transfer of immovable property when he makes a payment for it. So if I sell some property to you and you are making some payment to me, make sure you deduct 1% TDS. There's a restriction, the restriction rather easing off is that where the amount is substantial. Substantial is more than 5 lakhs. If the value of the property is within 5 lakhs, don't worry about it. No need to deduct TDS. When it exceeds 5 lakhs, you have to deduct TDS on the whole amount. Correct? Secondly, the provision does not apply in case where agriculture land is transferred. So where agriculture land is transferred, the provision does not apply. Okay. Now your section 87A. A rebate of maximum rupees 2000 is allowed to a resident individual, not to non-residents, not to HUFs, only to a resident individual. A maximum rebate of rupees 2000 is allowed provided his total income, the NTI, the net taxable income, you call it the total income, total taxable income, the net taxable income, if this is up to rupees 5 lakhs. So jiska NTI is up to rupees 5 lakhs, bichara garib hai, you give him a rebate, a further tax benefit of rupees 2000. And similarly, a surcharge has been introduced. So where today where you are earning more than 1 crore, you are liable to a surcharge of 10% and additional tax is charged to the extent of 10%. Remember, there will be a marginal relief if the excess tax is more than the excess income. Now, to make things very clear, you calculate your income at slab rates, your slab rates tax, along with it the income which is taxed at flat rates such as winnings, long term capital gains, your flat rates tax. This is the total tax, and before adding education cess at this stage you give your rebate under section 87A. Correct? This rebate is not fixed 2000, it is maximum rupees 2000. So what we mean is where this comes to 5000, you get a rebate of 2000. It is the actual tax or rupees 2000, the lower of the two. But let us say this is 1000, then the rebate can only be rupees 1000. It is the basic actual tax till this stage 1000, or you can say maximum of rupees 2000, the lower of the two. So 1000 was your rebate. Correct? So tax liability at this stage will be nil. If this is 5000, here we have 5000 or 2000, the lower will be 2000. 3000 is your balance tax. You add your education cess, less your prepaid taxes like advance tax, so on and so forth. You add your penal interest and all the other amounts to get your tax liability. But remember, the rebate is a deduction from the basic tax. Before education cess, you've got to make this adjustment. Similarly, if your total income crosses 1 crore, is more than 1 crore, if the NTI is more than 1 crore, then whatever is this tax, in this you add surcharge at the rate of 10% of this amount and you calculate the tax. And then your education cess, etc. Remember, there is a marginal relief. If the excess tax is more than the excess income, then the difference is allowed as a marginal relief. Okay, so we close it at that. We wish you all the best for your exams. If you have any queries, you can mail me at this address vp@idealclasses.com. This is my mail, vp@idealclasses.com. I'll be glad to answer you within a reasonable time. Wish you all the best for your exams. Hope you liked it.